Hello and welcome to the Opening the Gates July 2026 UK property market update. Thank you very much for those of you who are returning to watch this, and for those of you who are new here, welcome to the most comprehensive monthly property market update you're going to see out there. So for those of you who are new to the updates, I will be covering off my own data that I collate from a variety of different sources, such as 20EA. Going to be looking at house price indexes. I'm also going to be looking at the current environment for mortgage approvals, transaction numbers, inflation, interest rates, etc. We're going to be looking at the overall figures for year to date as well. So I'm going to start sharing my screen. I've got notes over here, so if you see me looking over there, that's what I'm doing. It is obviously incredibly hot in the summer, so if you can hear my fan in the background, I apologize. And if I need to break for a bit of water, we are in some crazy heat, which we clearly can't deal with in the UK. But what we can deal with in the UK is lots of political and economic uncertainty and all the turmoil out there. Do you like my little segue that I have started with? So let's start sharing the screen and run through the market update. So July 2026. So for those of you new to these updates, left to right, we have month on month. So July 26 versus the previous month of June. We've then got the middle column, which is year on year, July 26 versus July 25. And then on the final right-hand column, we've got July 26 versus the July 21-26 average. On the market means properties for sale. So up 1% month for month, almost 3% year on year, and 22% on the 21-26 average. So stock levels continue to rise, not at an astronomical rate, but there definitely is healthy amount of stock out there, as has been reported for quite a number of months, if not a couple of years now. Stock levels are at the highest they've been in the past dozen years or so. New listings slightly down on last month. There's going to be a few things we run through throughout the update, but of course we have had various things going on: heat wave, World Cup, tensions again in the Middle East, Andy Burnham as new Prime Minister, that might have screw-whiffed a few things. But when isn't there something going on in the market? Obviously, school holidays as well have just started up, and then just down 0.5% on a year ago, which is not bad at all. And actually, on the 21-26 average, sales are actually up. Sorry, start again. New listings, beg your pardon. New listings are up 6.7%. On 21-26 average. So it shows that there's still healthy appetite of sellers coming to market despite all those things going on. Sales agreed was steady month on month, down 5.2% on the year, and just 0.2% down on the 21-26 average. So shows that when interest rates get a little bit higher, that they have done in July, which I'll go through in more detail later, your passive aspirational buyers start to leave the market a little bit, go on holiday, there's uncertainty out there, etc. And then you've got the core market remaining. Price changes are down 2.5% month on month. I can't remember the last time I actually saw a negative reading on that. I might be wrong, but that's a bit of a surprise there. Up 2.4% on a year ago, and still a lot higher than 21-26 average, with price reductions 32% up. So lots more price reductions happening. I'll probably mention it a few times, but I will have a LinkedIn newsletter that's probably released by the time this goes out. And in that LinkedIn newsletter, there'll be a lot of information on price reductions. I shared a social media graphic recently on the quicker you sell a property, the better the price you achieve. So getting your property pricing correct from the outset is paramount. I will also be sharing a social media post very soon with some great data from Savills as well on the impact that price reductions have. Speaking of price reductions, price reduced properties are less likely to sell, take longer to sell, more likely to withdraw, more likely to fall through. So just to bear that in mind, withdrawals are down across the board. So it highlights that there is definitely confidence in the market from sellers to continue putting their best foot forward and trying to find a buyer rather than just going, do you know what, everything is against us, we'll just pull it from the market. Fall throughs are up month on month, which suggests that some people have been a bit hesitant and reluctant to move forward with the uncertainty that has been out there. But compared to a year ago, fall throughs are down 10%. Now that will be impacted by lower sale volumes from a year ago as well. And then 5.5% lower fall through rate compared to a year ago, which suggests that in the grand scheme of things across the last 5 or so years, there is actually a bit more confidence from buyers and sellers to move forward. Obviously, there's been information coming forward about surveys happening at start of sale, searches being applied for, sellers being legally ready. I'm a huge fan of all of those things, which can reduce time on market down, make you more saleable, and get you through to completion quicker. So I'm a big advocate of that. Right, on to prices. So let me just get my other screen ready. Beg your pardon. What I should say, just whilst we're on this, in terms of the year-to-date figures, which I'm now looking at on my other screen, properties for sales are up year on year, up 20% on the average. New listings are up 2.3% on a year ago, 9% on the average. Sales agreed are down just under 4% year on year and 2.5% on the average. Price changes are up just under 1% year on year and 29% on the average. Withdrawal numbers are 4.5% down year on year and on the average 9.7% up. And then fall throughs are down 8.5% year on year and 2.5% on the average. So in terms of asking prices and pounds per square foot on new listings, so new listings a year ago were 411,000. Last month they were 438,000. This month they're 415.5. Again, you will notice I think it's a Rightmove House Price Index, they talk about the slowdown in terms of seller asking prices. The average pounds per square foot was 372 a year ago, 387 a month ago, and 388 today. And then on the sales side of things, last year it was 366,666. Last month, 374,774, and this month, 366,810, with the pounds per square foot last year at 341, a month ago, 351, and this month, 349. So pretty steady across the board, shows that pricing has remained very stable, and you'll see that throughout the indexes as well, some up, some down, but pretty level throughout. And then in terms of the percentage changes on that, new listing asking prices are down 5% month on month, but up 1.1% year on year. Sales agreed asking price down 2.1% month on month, level with a year ago. New listing pounds per square foot up 0.3% month on month and up 4.3% year on year. And then sales agreed pounds per square foot down 0.5% month on month, but up 2.3% year on year. And then the year to date numbers, so average asking price of new listing sales agreed, and then for pounds per square foot, year on year average new asking price is 0.2% lower than the year to date from January to the end of July 25. Sales agreed asking price up 0.1%, and then pounds per square foot for new listings up 2.9%, and sales agreed up 1.8%. So again, pretty marginal activity there. So on to 12-month net mortgage approval for house purchases. Latest figures were 98,700. The 12-month average is 98,648. There were 93,530 a year ago. And then the 10-year average is 104,715. So in terms of mortgage approvals, month on month, are actually up 3.6%, which shows that interest rates went down a little bit following them going up with the conflict in the Middle East. So shows that buyer activity returned. Year on year, they were down 0.3%, and 12-month average down 7.2%, and on a 10-year average down 6%. So mortgage approvals a little bit lower than what typically is tracked. There are a few different metrics in there in terms of stamp duty, holidays, and the craziness of COVID, etc. But like I say, in a good market or a bad market, there are always things to caveat it. And then on transaction numbers. So transaction numbers, where are we? Sorry, the numbers I just gave, hold my hand up, complete error there, were the transaction numbers, beg your pardon. And then I gave percentages for mortgages. So that's not very helpful, is it? But I do these in one take, so we'll keep cracking on. The mortgage numbers, just going back, actual mortgage numbers, should I say, were where are we? Were 58,200 in June. Last year, they were 64,200, and they averaged 62,742 across the last 12 months. And then the 10-year average has been 61,918. So percentage I just gave were from that. The transaction numbers I gave were what I had previously shared. And then here we are on the transaction numbers. So in terms of the percentages on transaction numbers, month on month steady at a 0.3% increase, year on year up 2.5% on June 25 versus 12-month average 0.1% up, and then slightly down the 10-year average at 5.7%. So you can see there across transaction numbers, which are showing us what happened in the past. So that is sales activity from several months ago. And we've got the mortgage approval numbers, which are showing what's happening now, which will be a future indicator of transaction levels. You can see that things were better off a few months ago when interest rates were on the way down. Conflict in the Middle East has impacted that when mortgage approvals have dipped a little bit, but it's a few percent here or there. It's not the end of the world, I would say. And then onto the inflation rate. So inflation dropped this month to 2.6% below what was being forecasted. And that is now the lowest inflation number since March 2025. So really positive to see. Perhaps those inflation numbers being where they were is why the Bank of England voted to pause the base rate last week at the 3.75%. That's the fifth pause in a row now, but we went from a 7-2 split to a 6-3 split. So whilst there is no certainty around what will happen at the next meeting in September in about 5 or 6 weeks' time. We're getting closer and closer to maybe it going up to 4%, but lenders are already factoring that in, which is why we've seen interest rates rise, which I'll go through in some more detail in a little bit. Onto the house price index update. Rightmove down 1% on the month, annually down 0.4%. Zoopla steady on the month, 1.3% up annually. Land Registry 0.3% monthly rise, 2.7% on a year. Nationwide 0.1% up month on month, annually 1.8%. Lloyd's, which was previously the Halifax House Price Index, but the Halifax brand is being removed as Lloyd's own it, and it's just going to be Lloyd's now, just as an FYI. 0.2% up month on month, and then annually 0.6%. And then finally, eServe 328,800, which is 0.1% up on the month and 1.8% annually. So an average of 303.5, down on a monthly basis 0.05%. I don't think I've seen that for quite a while in these updates. Just shows where the market is hesitant in terms of pricing, and then up 1.3% annually. So still a little bit of growth there in the market. You'll notice home.co.uk is not in this month's edition. That is because they break for the summer holiday, and I believe that will be back next month. So those are the numbers I work on. Now we're going to actually run through and look at these house price indexes. Let's zoom in on these. So a larger than usual monthly drop of a 1%. Number of homes for sale is slightly below last year, but still very close to a dozen-year high that I said about before. The average 2-year fix, according to Rightmove, is 4.92%, down from 5.08% last month. This index, though, was the 20th of July. There's obviously been another week and a half of interest rate rises creeping up a little bit. The average July drop over the last 10 years has been 0.2%, but it was 1% this month. So shows that sellers are trying to tempt summer buyers with all those different distractions going on. But we spoke about World Cup, heat waves, summer holiday season has distracted some home movers. So number of sales agreed in the first half year was 6% lower than 2025. However, it was level with the first half of 24, indicating that many buyers are still being tempted if a property and price meeting their housing needs is right. Just goes to show price competitively, market correctly. There is a buyer out there in this market, despite what people say. So competitive initial asking price is critical to a successful sale rather than relying on a later price reduction. Rightmove analysis of all homes sold so far in 26 has found that nearly 3/4 sold without needing a price reduction. So many of the fundamentals underpinning the market remain sound. Lenders competing strongly to lend. They want to do business even if they are having to creep up with their interest rates. Wages are still rising faster than house prices, and that's helped affordability a little bit. And unemployment is still actually, in terms of overall perspective, still remaining pretty low. Political change is obviously adding further uncertainty to the market and adding to the distractions that buyers are facing this summer with the new Prime Minister, Andy Burnham. Obviously, there's lots of different things that were mentioned about stamp duty reform, council tax change, etc. But Andy Burnham has poo-pooed that, which maybe gives us a bit of certainty in the meantime. I actually know that on Friday, the autumn budget got announced as well. And I believe that is going to be the 28th of October for Mr. Healy's first budget. Hopefully, it's been better than the ones we've had in the past for the property market, though we're not expecting much change. I don't think there was anything else to report much of. I think there was this bit actually So just to repeat it again, home movers are always distracted by some holidays, obviously, but this year had the World Cup and the heat waves to contend with, plus all political uncertainty. Right move analysis shows that the first heat wave in May caused an 8% drop in buyer demand before rebounding, and the June heat wave caused a similar temporary decline of 6%, followed by a 4% dip in the current July heat wave. So maybe we're getting a little bit used to it as a country with these heat waves as the demand drop has crept down a little bit each time we've had a heat wave, which is positive to see. And then actually, I do just want to touch on this bit here. So after the first half of 26, there's been a share of challenges for home movers to navigate. After obviously an encouraging start to the year, we then had the unexpected conflict in the Middle East, which elevated mortgage rates due to that unexpected conflict. Number of sales agreed in the first half year was 6% lower than the same period last year. However, it's important to remember the context of that period because of the stamp duty holiday at the end of March. Salisbury remain in line with 2024, which is good to see. So it does highlight how price sensitive buyers are in the current market with affordability stretch with higher interest rates. And then Rightmove again reiterate the importance of getting the price right. So 74% of homes have successfully completed this year without the need for a price reduction. However, those that do need a price reduction spend an average of 127 days on the market compared to just 36 days for those who sell without a reduction. So the findings underline how important it is for successful sellers to price correctly from the outset. And if they are needing to adjust the price, they need to do it sooner rather than later. So political change did add another layer of uncertainty to the market. But I think Andy Burnham has poo-pooed a few of those things since this Rightmove House Price Index got released. Right, on to the Zoopla House Price Index. So higher mortgage rates and political uncertainty have driven a sharper than usual summer slowdown. So much what Rightmove said Zoopla reported, with sales agreed 9% lower in July. House price inflation has slowed to 1.3% from 1.7% a year ago. More homes for sale has added to negotiating power for buyers. Zoopla expects a pickup in activity from September, provided the mortgage rates do hold steady. As always, great content from Richard Donald. The gap between housing hotspots and cold spots is as wide as we've seen all year. Agents and developers who price local conditions, not the national average, are best placed to convert the September pickup in sales. If you want to know how to find out more local information on your market, please do give me a shout. I can help with that. So elevated mortgage rates and political uncertainty slowed the housing market activity, as you can see from the graph below. So we had the 22 mini budget where it dropped and interest rates went above 6%. Sales then rebounded with the drop in interest rates. We then had, of course, the rush to beat the stamp duty headline. We had the autumn budget speculation as well that dampened activity a little bit. And then we've had elevated mortgage rates in the past few months as well. So you can see there that things have gone up and down a little bit like a yo-yo. So on this, average mortgage rate eased from April's peak of close to 5% to 4.6%, 4.65% in June, before ticking back up to 4.75% in July as the tension in the Middle East continued. Since January, rate rises have added roughly £125 a month or £1,500 a year to a typical mortgage. So buyers have got more choice. Their negotiating power has reduced. Therefore, sellers need to price competitively. They need to market the houses amazingly to stand out. Going back to what I said earlier, searches up front, survey up front, put on your advert that you're legally ready, have video tours, drones, Twilight, make it stand out, and you're going to increase your chances of selling. So as I said, great choice for buyers, increasing their room to negotiate. There's some really good Connell's research that came out. If you've not seen that, message me and I can send it to you. Connell's highlighting reduced properties are less likely to sell was one key thing. Also, I think less properties are selling in a quicker time, and lesser properties are selling after a reduction as well. So it just showed how important it is to get it right from the outset. I won't touch on the local conditions on that. So moving on to Nationwide. Nationwide was quite an interesting one this month because there's a few different things they looked at. And I'm actually just going to get the notes in my book that I wrote down from this. Nationwide, house price growth slowed to 1.8% in July from 2.2% in June. House prices were up 0.1% month on month. So sitting at the 277,542. So I'm just going to quickly read through, where am I? What am I doing? This bit here. So Robert Gardiner, chief economist at Nationwide, has said prices remain broadly flat after taking account of the seasonal factors. Market activity and house prices have remained soft in recent months, in part reflecting the uncertain economic backdrop. Geopolitical tensions remain high, with the conflict between Iran and the US again exerting upward pressure on energy prices and market interest rates in recent weeks. Financial market expectations for the future path of bank rate have been volatile, reflecting shifting views about the inflationary implications of events at home and abroad. Despite the ongoing risk from the latest energy price shock, the MPC can take some comfort from the fact that consumer price inflation, so CPI, declined further in June. Signs that wage growth has continued to ease gives policymakers more breathing space to assess the extent to which tighter policy is necessary to ensure inflation returns to target. Just on the MPC, I read something the other day, and I'm not going to be able to remember the exact language, but it was some phrase like phantom hiking, which I've never heard before, where if they give off the impression that the base rate might rise a little bit, that does the work for them. Lenders will increase rates a little bit, and they can actually just pause the base rate where it is, and who knows, that might happen. Now, the other information on the screen comes from the 24-25 English Housing Survey. And basically it's talking about the ownership of different types of people. So hopefully I read this correctly. Average ownership sits at 14 years. Now, those who are moving with a mortgage have been in their home for 9 years. Those who own their property outright have been in their home for 24 years. And a third who own their property outright have been in it for 30 plus years. 25% of mortgaged homeowners have been in a home less than 2 years. So it gives you a really good insight for different ends of the market, how long they live in their home for. So if you want to have a conversation with me around what those numbers look like on a graph, I can send over the data I've got to you. And I can also have a discussion with you around the data within your actual database and who you need to be targeting. This is why it's so important for birthday cards, Christmas cards, anniversary cards, to those who bought for you in the past. Those who've sold through you and bought locally again for another agent, you want to make sure you duplicate that record in your CRM. And then in terms of the anniversary side of things as well, it's a widely known statistic, but about 85% of properties don't sell through the estate agent they bought through because they go into witness protection. So if you need any help on how you can get returning clients, please do let me know. I think roughly 25% of the houses I sold in my last year as an agent were people who've done business with me before. They're more likely to return to you, so higher conversion rate. They're more actually willing to pay a higher fee because they've experienced your amazing service. So why not continue going after that business that you've already got? Lloyd's House Price Index. I think this is the last one where it has actually been Lloyd's rather than Halifax. So as I said earlier, Halifax name is being got rid of as they're owned by Lloyd's. So average house price just above 299, monthly change 0.2% up, quarterly down 0.4%, annually still up 0.6%. So 0.2% increase in June follows a 0.2% fall in May. An annual growth up 0.6% versus 0.5% in the May. So Amanda, head of mortgages at Lloyd's, has said house prices rose for the first time in 4 months during June. The typical property now costs just over 299,000. So recent price trends continue to reflect wider economic uncertainty, including the impact of global events on inflation and interest rate expectations. Whilst affordability remains stretched for many buyers, mortgage rates have eased from their recent highs, offering some encouragement to those considering a move. While latest entry data shows the number of new mortgage approvals dropped in May, this wasn't unexpected given the spike in rates seen earlier this year, and they'd expect the activity recover, assuming borrowing costs continue to fall. For first-time buyers, annual price growth increased to 0.8% in June from 0.3% in May, with the average first-time buyer property now costing £240,433, suggesting demand remains resilient. Looking ahead, they expect the housing market to continue moving at a measured pace. Lower borrowing costs should provide some support for demand, though affordability constraints remain an important factor. The outlook for house prices will depend largely on inflation continuing to ease and household confidence gradually improving. And then on to the penultimate house price index, which is from eServe. So GP house prices are still rising slowly, according to eServe. They are at 328,800, up 1.8% year on year. And monthly growth remains modest at 0.1%, and it has eased from May. Buying, this is really, really interesting information here, which is included in my newsletter. Buying costs around 78% above June 2019 levels. Mortgage approvals are only 6% lower over the same period. So it shows that buyers are still there. They have still got appetite to move, but they're perhaps becoming a lot more price conscious because of the increased cost of borrowing, but still pretty healthy mortgage approval levels, all things considered. So buyers are more active. Buyers are active but more price sensitive, as I said. Um, so this, where was the bit I wanted to show you? This is it. This is the image here. So mortgage backed demand has held up better than the rise in buying cost might suggest. The chart compares the house prices, the monthly cost of buying and mortgage approval since June 19, giving a pre-pandemic benchmark for how the prices, cost and demand have shifted. So you would expect with how much this line has risen here, you would expect house prices to have dropped more and mortgage approvals. It's incredible how resilient the market has been. So buying costs have risen much faster than house prices. House price around 24% above June 2019 level, while the monthly cost of buying the average home has gone up by 78%. Mortgage approvals that have recovered despite this high cost base on a 3-month average approvals were around 6% below their June 2019 level in May 26. And after falling much further during the 22 and 23 shock. So again, just like the heat waves, maybe as a nation, we've got a little bit more used to these higher interest rate environment. So it points to a market where demand remains, but buyers have become more selective. High mortgage costs are limiting borrowing capacity and making buyers less flexible on price. Homes priced within local budgets can and definitely are still selling. Homes priced above that level are more likely to take longer, be renegotiated or fall through. As I said earlier, price reductions will have that impact. There's a really good study from the Q2 20 CI Home Mover report highlighting just how many properties are now being overvalued by, I think, 5 to 10% or 10% plus. So there's plenty of overvaluation in the market. Now, I think it's six of one, half dozen the other. Some of it is the agent, some of it is the seller. If you want any advice on how to have better conversations around pricing in the living room, hit me up. I'll be very happy to share plenty of data and content that I have on that. So the outlook from eServe, house price growth is likely to remain modest over the second half of the year. Political change in Westminster may bring housing policy back into focus, including council house building, and possible reform of council tax and stamp duty. Obviously, that has been poo-pooed for now. This came out before Andy Burnham made his comments. However, any changes would take time to affect the market. In the near term, markets will be watching policy signals ahead of the autumn budget at the end of October for any impact on funding costs. Mortgage rates have started to edge lower again. Older data, they've started to go back up, which would have helped buyer confidence. It's now dented it a little bit. Affordability does definitely remain tight, but a more stable rate environment would give buyers and sellers greater confidence on pricing. Right, on to the final leg now, and then before I talk about interest rates. So UK house price index. So we are sitting at May 26, 271,295, May 25, 264,078. So you see there has been some growth in the market, and property prices are actually sitting at pretty much their highest ever price, only a couple hundred quid down on the autumn last year. If you go back to the start of 2020, before COVID happened, they're up on the 213,657. So annually, prices are up 2.7%. Monthly, they're up 0.3%. And I just want to highlight this bit here. So average UK house price inflation stands at 2.7%. That's down from 3.9% the month before. Slowing in the UK annual rate was driven by a base effect from the aftermath of last year's stamp duty changes in England, Northern Ireland on the 1st April 2025, which I alluded to earlier, similar to effects seen previously. And then the annual rate slowed in May 26 because average UK house prices rose by a smaller amount, 0.3% between April and May, than in the same period a year ago of 1.5%. So that is all the house price index is done. Going to move on to interest rates now to finish off this recording. So really good link on Rightmove. So rightmove.co.uk/news/articles/property-news/current-UK-mortgage-rates. That was a mouthful. So this gets updated every day, I think, Monday to Friday. And you'll notice that everyone reports these slightly differently, which is why you'll see different numbers, but it's always good to look at the varying ones. So the average 2-year fix, according to Rightmove, currently sits at 5.11%, up slightly on the week and up on a year ago. And the 5-year is more expensive, 0.06% up on a week ago and 0.62% up on a year ago. Those interest rates, I would have said it before, now having a 5 in front of them again rather than a 4 is a real psychological factor for the market. So many people out there clearly said when rates get to below 5 and have a 4 in front of them, we'll make our move. And the same for the lowest rates as well. When rates were on their way down, they had a 3 in front of them for the lowest. They now got a 4 back in front of them. So 2-year fixed lowest is 4.42 with a weekly change of 0.09% increase, yearly up 0.73%, and the 5-year fixed at 4.57% up 0.14% on a week ago and 0.73% on a year ago. And the final thing I'm going to highlight to you is the Money Facts average mortgage rate. This is something I track. I get emailed every day, Monday to Friday at the close of play. And for the avoidance of doubt, I'm recording this on Monday, the 3rd of August. So March 5th, 2026, the average mortgage rate according to Money Facts was 4.89%. I've highlighted this because this is when rates had stopped going down and had steadied as the conflict in the Middle East really started to kick off. We then saw them peak in early May at 5.67%. Then we started to see ceasefires and they came back down to 5.42% in the middle of July. And then things opened back up again with conflict, which has meant that they closed the end of July at 5.59%. So I want to highlight the difference between 4.89% and 5.59%. So if you're buying a pretty reasonably priced property in the UK at 300,000 with a 10% deposit, a repayment period of 30 years at a 4.89% rate, which is where we were before the conflict, your average mortgage would have been 1431 a month. It now stands at 5.59%, which means it's 1,548. Now minus what we had before, that's an extra £117 a month on a typical borrowing over a 30-year period. Now, the other thing to consider is that interest rates have gone from 4.89% to 5.59%, which is a 0.7% difference. Basically, for every 1% change up or down, it impacts purchasing power by 10%. So at 0.7%, that's going to be a 7% change in buying power. So what I mean by that is that if someone was buying at 300,000, that was their budget back in February, March, they would now be looking at spending 280,000 just to keep their mortgage repayments the same. Or if they want to continue buying at 300, they've got that extra £100 in it. So imagine a property is on the market a few months ago for 310,000, but all the comps said 300. Now those buyers actually affordability is 280. The property has gone from 20 grand too much to 30 grand too much. So I hope that makes sense there. So that has been the July and year-to-date Open the Gates 2026 property market update. If you've got any questions at all, anything you want to follow up on with me, please do give me a shout. I'll be back in early September to report on the August market update, how the school holidays have gone for activity and pricing, how it compares to the previous month of July, and if there's anything you want including, excluding for any future updates, please do let me know. I've been Simon Gates, and I look forward to seeing you next time.